We did get the S&P 500 moving yesterday into a new bull market. You can see it's holding on to gains today, up about 0.5%. But our guest says stocks have rallied too far, and he wouldn't be surprised to see a 5 to 10% correction in U.S. markets. We're joined by Mike Vinokur, portfolio manager at IA Private Wealth. It's great to see you.
Thank you for having me.
So you're here to spoil the fun. Do you think the market could go down 10% in fairly short order?
I think so. We've seen a very sharp rally off the October lows, and I'm not bearish per se, but it wouldn't surprise us to have a 25 to 50% correction of the move that we just had. So if we've just gone up 20%...
Since October.
Yeah, since October. So a 5 to 10% correction is not out of normal territory.
Is it the narrow base, just a few stocks doing all the work?
Yes. If you look at the broad-based markets, for example, the S&P 500, I think 5 or 10 stocks accounted for most of the gains. The other 490 have barely been lifting their weight. If we get a much broader rally, perhaps we can get more strength in the average market. But my concern is that what took us up may take us back down as some of the investors take their profits in some of these names.
And we are going into what's traditionally been a lackluster period of the year for stocks.
Yes. Generally speaking, if you look back at the last 20, 30 years, June has never been a great month for stocks. And we think based on the technical patterns and the seasonality, somewhere in the June-July period, we should have some kind of a correction comeuppance, pause to refresh, if you will, and then perhaps another upward move into the Q2 earnings season.
You have been raising cash then in some of your portfolios, some of your accounts.
We have, yes. We decided to get a little bit defensive just because we thought that perhaps people were a little too bearish back in October, and now the sentiment has shifted a little bit too much, and so we wanted to be cautious going into this period.
You have some stock ideas for us. Uber, they're just crushing Lyft?
They're crushing Lyft. Uber is I would say, a category killer, if you will. They've got rideshare, they've got Uber Eats, they've got freight. They've got what I would say is a huge network effect. And what I mean by that is so many people already on their platform that they're able to monetize that client base in many other ways, such as advertising, such as co-brand marketing. So it's not just the rideshare business, which is going to become very accretive on capital in short order. It's all these other abilities for them to use their systems to monetize and increase their own revenues.
What about, are you going around Toronto, you see multiple food delivery services. So the barriers to entry don't seem that high.
They're not. But what we like about Uber is the fact that it's, in our view, a more or less capital-light business. Yeah. In other words, they have the technology. They have essentially, they're a talent booking agency. They're booking the ride through their system, but they don't own the vehicle. Yeah. They don't own or employ the driver necessarily. It's on a come-as-you-go basis, and they operate this whole platform.
Yeah, they don't have fleets of cars or motorbikes or anything. Yeah. Your next idea, Citi Group. You think U.S. lenders are cheap, generally speaking?
Yeah. The big U.S. money center banks are, in our view, very well capitalized. And the turmoil that has happened since March in the U.S. banking system, given the regional banks and the fear of collapse or having the FDIC having to rescue the institution that you deal with, we believe has had a flock of clients going to the big money center banks. So all of them, I believe, including Citigroup, have probably benefited. But Citigroup is trading at a very cheap valuation. It's 40% below approximately tangible book value. It's got a very high capital ratio. They've announced plans for their Mexico Banamex division. It's got a great yield, and I quite like management.
Okay, yeah. Why is the market cool on Citigroup, do you think?
It's had many troubles in the past.
Sure.
Back in the days of Mr. Prince, when he went on a big acquisition spree, and then 08, 09, if you look at the price of the stock before they were rescued, it's still 90% off or 93% off its previous highs. But I think the market needs to realize that today Citigroup is a very different animal. They've pared back a lot of their international businesses. They're really looking at returns on capital. I think Jane Fraser is a great leader, and I think she's got the right people in place and the right strategy over the next couple of years to really get shareholder value going here.
Okay. And then your final idea, Parkland, the Canadian fuel retailer. Why do you like them?
I think Parkland is a great capital allocator. It's a simple business. They own gas stations. They own convenience stores. They're now into charging stations. They own a refinery. Their management team has a plan to get to $2 billion of EBITDA in the next couple of years, and the whole market cap of the company is only $6 billion. So it's a very simple business, spinning off a lot of cash flow. You just got a dividend bump most recently of 5%. You've got a stock yielding 4%, and I think there's a lot of trajectory going higher.
That's interesting, yeah. And actually, speaking of 4%, I see the dividend yield on Citi has now gone to about 4.2%.